You know what's interesting? When it comes to real estate, we're taught to put our name on everything: the deed, the mortgage, the mailbox. But what if that visibility is actually the biggest risk to your financial future? Every property you sign for is a public record. It's a breadcrumb trail for anyone to follow: nosy relatives, opportunistic lawyers, even angry tenants. They can see what you own, guess at your net worth, and decide you're a target. The traditional path to real estate investing makes you easy to find. But what if you could build your portfolio in the background, quietly? You're about to learn how to build real estate wealth privately, using legal strategies that separate your assets from your personal name. Each move we'll cover is a layer of protection for your portfolio, making it less visible to the public eye. This isn't about hiding from taxes or legitimate obligations. The IRS will always know what you own. This is about protecting yourself from frivolous lawsuits and unwanted attention. We're not just building wealth, we're building it quietly and strategically. Before we get into the 13 moves, you need to understand one core principle: separation. Separating your personal identity from your assets. In a world where a quick online search can map out everything you own, that visibility becomes a liability. It can make you an attractive target for lawsuits simply because someone can see you have assets. Privacy is your first line of defense. These strategies are all legal, ethical, and used by sophisticated investors to build their portfolios without broadcasting it to the world. It's about controlling your own financial narrative and protecting your family's future. Let's start with the cornerstone of real estate privacy. Move 1. Use a Wyoming LLC for anonymous ownership. The first move is a fundamental building block: the Wyoming LLC. While a few states offer anonymous LLCs, Wyoming is a popular choice for real estate investors. Here's why. Wyoming law doesn't require the names of the LLC's members or managers to be listed in the public articles of organization. This means from day one, your personal name can be kept separate from the company that will own your properties. But the real strategy is in how you structure it. You can form a primary LLC in Wyoming. Let's call it your holding LLC. This company won't own real estate directly. Instead, its purpose is to own other LLCs. Then, for a property you acquire, you can form a separate LLC in the state where the property is located. We'll call these property LLCs. The public record for each property LLC will show its owner not as you, but as your Wyoming Holding LLC. Let's make this concrete. Someone gets injured at your rental property in Texas. Their lawyer searches the public record. They won't see your name, they'll see Texas Property 1 LLC. If they dig deeper to find the owner, the record points them to Wyoming Holdings LLC. They've hit a wall in the public records. Now, let's be clear. This isn't about becoming a ghost to the government. With new FinCEN reporting rules, the IRS will still know who the ultimate owner is, and a determined lawyer can file lawsuits to uncover ownership. The goal isn't to be completely impenetrable. It's to create a strong layer of privacy from the casual observer and make it much more difficult and expensive for someone to target you frivolously. This structure also compartmentalizes risk. A lawsuit against Texas Property 1 LLC is contained there, protecting your other properties held in separate LLCs. One problem can't burn down your whole portfolio. Move 2. Deploy anonymous land trusts. If the LLC is your legal shield, the land trust is your privacy cloak. A land trust is a simple legal agreement where a trustee agrees to hold the legal title to a piece of real estate for a beneficiary. The trust agreement itself is a private document. It's not filed with any government agency. The only thing on the public record is the deed transferring the property into the trust. Here's how it works. Let's say you're buying a property. You might need to secure financing and purchase it in your personal name at first. Immediately after closing, you can execute a new deed, transferring the title from your name to a land trust. You can give the trust an anonymous name, like the 123 Main Street Trust. You then appoint a nominee trustee, like an attorney or a specialized company, whose name appears on the public deed. Suddenly, your connection to the property is removed from the public record. But here's the key part most people miss. A land trust on its own offers privacy, but in most states, it offers little asset protection. If someone is injured on the property, they can still sue the beneficiary of the trust once discovered. So, who do you name as the beneficiary? Not yourself. You name your anonymous Wyoming LLC from move number 1. Now you have a 2-layer structure. The public deed shows a generic trust name, hiding your identity. If a persistent person investigates the trust, they won't find you. They'll find your anonymous LLC, which leads them back to that Wyoming privacy wall. It's an elegant structure that separates public title from private control. Move 3. Invest in private real estate funds. So far, we've talked about properties you directly control. But what if you want to build wealth completely passively, without your name ever touching a public record? Welcome to private real estate funds. This is where a lot of institutional and ultra-wealthy money is invested. These funds pool capital from many investors to acquire large-scale assets that are typically out of reach for individuals, like apartment complexes or industrial warehouses. When you invest in a private fund, you're not buying real estate. You are buying a security, a share in the fund itself. The fund is the entity that acquires the properties. Your name appears nowhere on any of the property titles. You are a silent, invisible partner. All you do is contribute capital and receive your share of the income and appreciation. This offers a few powerful advantages. First, instant diversification across many properties and markets. Second, it's truly passive. A team of experts handles everything. Third, and most important for our goal, it offers complete anonymity at the property level. The main barrier to entry has historically been the accredited investor requirement, which generally means you need a certain income, $200K individual, $300K joint, or a net worth over $1 million, excluding your primary home. While there have been discussions in recent years about expanding this definition, as of 2026, these are still largely the rules in place. Move 4. Use turnkey properties for passive income. Imagine this. Every month, a deposit hits your bank account. It's rent from a property you've never seen, from a tenant you've never spoken to. This is the idea behind turnkey real estate. Turnkey companies find properties, renovate them, place a tenant, and then sell the stabilized asset to an investor, usually with property management already in place. The appeal is efficiency and passivity. You are buying a cash-flowing asset, not a second job. From a privacy perspective, the turnkey model is very clean. You purchase the property using your anonymous LLC from move number 1. The deed and tax records are all in the LLC's name. A professional property manager handles all tenant communication. The tenant calls the manager for maintenance, not you. To the public, the owner is a faceless company. This also lets you invest in affordable, higher cash-flowing markets, even if you live in a high-cost area. The key is doing thorough due diligence on the turnkey provider. You're buying their system as much as you're buying a house. The returns might be slightly lower than a hands-on project, but the trade-off is a scalable, passive income stream that builds your wealth quietly. Move 5. Fractional ownership through crowdfunding. What if you could own a piece of a Miami apartment building or a portfolio of vacation rentals, all for a few $100s? That's the power of fractional ownership through real estate crowdfunding. This has made real estate investing more accessible by allowing you to buy shares or fractions of individual properties or diversified funds. Here's how it works. A crowdfunding platform acquires a property under a dedicated LLC. Then, they offer shares of that LLC to investors on their platform. You aren't buying the property, you're buying a stake in the company that owns it. The platform handles all management. In return, you get your share of the rental income and any appreciation when it's sold. For the stealth wealth builder, this is a masterclass in anonymity. Your name appears on 0 public records tied to the property. You are just one of many anonymous investors in the background. Platforms like Fundrise or Arrived have made it possible for anyone to start building real estate wealth without the traditional barriers of large down payments or management duties. The trade-off is a lack of control and liquidity. You can't decide when to sell, and your investment is typically locked up for several years. Still, it's a great tool for quietly building a diversified foundation. Move 6. House hack silently with an FHA loan. This is one of the most powerful strategies for a first-time investor. House hacking is when you buy a multi-unit property, a duplex to a fourplex, live in one unit, and rent out the others. The rent from the other units can cover a big part, or even all, of your mortgage. Your tenants are essentially buying you an asset. What makes this so effective is pairing it with an FHA loan. These government-insured mortgages are great for first-time homebuyers. While a typical investment loan might require 20 to 25% down, an owner-occupied FHA loan lets you buy a property with up to 4 units for as little as 3.5% down. On a $500,000 fourplex, that's a down payment of $17,500 instead of $125,000. So where does the silent part come in? At purchase, you have to be the owner-occupant, so the loan and title will be in your name. FHA guidelines require that you have the intent to occupy the property as your primary residence, and you're generally expected to live there for at least 1 year. Moving out too soon without a good reason could be seen as mortgage fraud. However, after that period, your plans can change, and you are free to move out and rent your unit. At that point, you can implement your privacy shields. You can transfer the property into an anonymous land trust with your LLC as the beneficiary, just like in move number 2. Your name disappears from the public record, but you keep a cash-flowing asset. All right, we're halfway through, and we've already covered some powerful strategies. I know this can be a lot to digest, and the specific legal steps can feel complicated. To help you keep it all straight and actually put these moves into action, I've put together a free downloadable PDF called the Stealth Wealth Blueprint. It's a checklist that walks you through these concepts, like setting up an LLC and structuring a land trust. It's the framework I use. There's a link in the description. It's completely free. Just my way of making sure you have the tools to do this right. Now, let's get back to it. Move 7. Syndicate anonymously as a silent limited partner. This move is how you start participating in multi-million-dollar deals without being in the spotlight. A real estate syndication is a partnership where a sponsor finds a large deal, like a 200-unit apartment complex, and raises money from passive investors, called limited partners, LPs, to fund it. As a limited partner, your role is simple. You provide capital. The sponsor does all the heavy lifting, finding the deal, getting the loan, managing the property, and executing the business plan. You are a silent financial backer. Your name isn't on the loan or the property title. Your investment is made through a private legal document. For the stealth investor, this is an ideal scenario. You invest in high-quality assets with complete anonymity at the property level. You get the benefits of direct ownership, cash flow, appreciation, and tax advantages like depreciation, without the management headaches or public exposure. Like private funds, these deals are typically open only to accredited investors. It's a way to scale your wealth quietly by writing a check and letting a professional manage the asset, while you collect distributions in the background. Move 8. Stack series LLCs with land trusts. Now we're getting into more advanced, multi-layered strategies. This move combines the privacy of a land trust with a specialized form of LLC, the series LLC. With a standard LLC, if you own 5 properties in it and one gets sued, all 5 are potentially at risk. A series LLC is a unique structure that lets you create a master LLC and then establish individual series underneath it. Each series functions like its own separate LLC, with its own assets and its own liability shield. Think of it like a file cabinet. The series LLC is the cabinet. Each drawer is a series, and you place one property in each drawer. A lawsuit involving the property in drawer A can't reach the assets in drawers B, C, or D. This gives you the protection of having a separate LLC for each property, but with the lower cost and administrative ease of one main filing. It's important to know that only certain states, like Delaware, Illinois, and Texas, have well-established series LLC laws. Wyoming has also recently added support. The liability protection between series has also not been fully tested in all courts. Here's how you stack it for privacy and protection. Form a Series LLC in a state that allows it. Place each property into its own anonymous land trust. This handles the public-facing privacy. Name a specific series of your LLC as the beneficiary of each land trust. Now, an attorney looking at the public deed sees a trust. If they dig into the trust, they find Series A of XYZ Holding Company, LLC. If they sue Series A, their lawsuit is contained there. It can only reach the assets in that one series, protecting the rest of your portfolio. Move 9. Airbnb arbitrage under a business name. This is a clever strategy for generating cash flow with minimal capital and zero public ownership. It's called rental arbitrage. The concept is simple. You sign a long-term lease on an apartment, and then, with the landlord's permission, you re-rent it on a short-term basis on platforms like Airbnb. The arbitrage is the difference between the high nightly rate you collect and the fixed monthly rent you pay. For example, you lease an apartment for $2,500 a month. You furnish it and list it on Airbnb for an average of $200 a night. With a 70% occupancy rate, you gross $4,200. After rent and operating costs, cleaning, utilities, etc., you might have a net profit of $800 a month. And you did this without a down payment or a mortgage. From a stealth perspective, this is a great play. Your name is on a private lease, not a public property deed. The income from your Airbnb operation flows into your anonymous business entity, your LLC. You can generate significant income without any corresponding assets appearing in a public search of your name. The keys are picking the right market, getting clear written permission from the landlord, and professional management to keep it passive. Move 10. The BRRRR method via anonymous entities. The BRRRR method, buy, rehab, rent, refinance, repeat, is a popular strategy for building a portfolio with little money left in the deal. When you combine this with the privacy structures we've discussed, it becomes a machine for recycling your capital in the shadows. Here's the breakdown. Buy. You purchase a distressed property at a discount using short-term financing like a hard money loan. The purchase is made by your anonymous LLC or trust. Rehab. You renovate the property, forcing appreciation and increasing its value. Rent. You place a long-term tenant, establishing a stable income stream. Refinance. This is the key step. You get a new, long-term mortgage based on the property's new, higher appraised value. Often, the new loan is large enough to pay off the original purchase and rehab costs, allowing you to pull your initial capital back out tax-free. Repeat. You take that same capital and use it to buy the next property. By using your anonymous entities, your ownership is hidden through the whole process. You're effectively building a portfolio with an infinite return, since you get your original cash back. You're using the same pot of money over and over to acquire more assets, all without your name on any public records. Move 11. Secure private lines of credit. What if you could become your own bank? This advanced strategy allows you to create a private line of credit to fund deals without needing to qualify for a traditional mortgage. It involves using the assets you already own within your anonymous structures as collateral. Here's how it works. Let's say you own a property free and clear inside Property LLC A. Your holding LLC, the parent company, acts as a private lender and extends a formal loan to Property LLC A, secured by a publicly recorded mortgage or deed of trust. Now your holding LLC has a secured note. You could then take this note to a specialized lender and sell it or borrow against it, injecting cash into your holding LLC to fund the next purchase. Or, even more powerfully, if you have a self-directed IRA with significant funds, your IRA could be the source of the capital. Your IRA lends money to your holding LLC, which then lends to your property LLCs. The property LLCs pay interest, which flows back into your tax-advantaged retirement account. You are literally paying yourself interest. This creates a closed-loop system for funding. It's fast, flexible, and completely private. No personal guarantees or credit checks. It turns your portfolio into a private bank, allowing you to borrow against assets you secretly control to fund new acquisitions. Move 12. Wholesale deals off market. This is the art of making money from real estate without ever owning property. A wholesaler finds distressed properties from motivated sellers and gets them under contract at a deep discount. Then, instead of buying the property, they assign the contract to another buyer, like a house flipper, for a fee. Let's say you get a property under contract for $150,000. Your contract is in the name of your anonymous LLC and includes an and/or assigns clause. You then find a cash buyer willing to pay $170,000 for it. You sign an assignment agreement, and at closing, the title company pays the seller their $150,000 and pays your LLC a $20,000 assignment fee. You just made $20,000 without taking title or using your own money. From a stealth perspective, this is flawless. The transaction happens between your anonymous LLC and the end buyer. The fee is paid directly to your LLC's bank account. You are a quiet middleman connecting deals and taking a cut. The key to success is marketing to find sellers and building a list of reliable cash buyers. It's a great way to generate active income to fuel your long-term passive investments. Move 13. Form your own micro private equity fund. This is the final move that ties everything together. It elevates you from a hidden investor to a quiet fund manager. So far, you've learned to buy properties anonymously and invest passively in other people's funds. Now, it's time to become the sponsor. You can form your own micro private equity fund, which is a vehicle for pooling capital from other accredited investors to execute a specific real estate strategy. You act as the general partner, GP, likely through your anonymous Wyoming LLC. You create a formal plan. Maybe you'll focus on BRRRR deals or acquiring turnkey rentals, and raise capital from limited partners, LPs. With this pool of capital, you can now operate on a much larger scale. Your fund, managed by your anonymous GP entity, acquires the properties using the layered LLC and land trust structures we've discussed, ensuring privacy for the entire portfolio. As the GP, you earn fees for managing the fund and a share of the profits. This is the ultimate stealth wealth key maneuver. You control the deals, GP use other people's money to scale, and your role is shielded behind your anonymous entities. It's the culmination of everything we've learned, allowing you GPP portfolio without anyone ever connecting your name to it. We've just walked through 13 strategies for building real estate wealth privately. We started with the foundation of an LLC and layered on the privacy of a land trust. We explored passive strategies like turnkey properties and fractional investing, and active strategies like house hacking and wholesaling. Finally, we looked at advanced structures like series LLCs and forming your own fund. The common thread is a shift in mindset. Wealth isn't just about what you own, it's about how you own it. Public visibility is a vulnerability. Privacy is a strategic asset. By separating your identity from your assets, you give yourself the freedom to build and grow without the noise and threats of the outside world. This is the blueprint for quiet wealth. The income appears, the equity grows, but your name remains your own. You now have the blueprint. The only question is, which move will you make first?